From New York City, for our viewers worldwide, I'm Manus Cranny in for Jonathan Ferro. So we've put in some more record highs on these equity markets. We're counting down to maybe a hawkish tilt from the Fed, but volatility is below average for 99 sessions in a row. That's a bit of a trek. We're going to see whether that holds. It's Countdown to the Open. Kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up, those stocks are flirting with record highs as the Fed takes center stage. Investors brace for the latest rate decision as the dot plot thickens. And the Biden administration provides a big boost for shares of Intel. We begin with the big issue, counting down to Chairman Powell.
Not that much has to change in terms of the projections. If you go back to 2 weeks ago when Chair Powell testified in Congress, he said they were, pretty close to having enough confidence. So that sounded like, a cut no later than June. If you take the statements there, we've had higher inflation numbers in the past week. So the question is, has that changed his view? My expectation is no, but we'll find out.
How much of this hawkish tilt might already be in the market? Mike McKee is with us. He's in Washington, D.C., setting the stage. You're hunkering in there, Mike, for what's going to be a very interesting day, pivotal day, some people say. Good morning.
Good morning. A lot to look at today, Manus. The Fed has confirmed that the meeting is underway now, so we just have to wait until 2 p.m. for the results. The first thing everybody's going to look at, we've been talking about this, is the dot plot. Do they go from 3 cuts this year to 2 cuts? Right now, the market says 3 still. This is this morning's interest rate projections. It's sort of a tie between June and July over when they have the first cut, but then another cut's priced in for September, and a third cut is priced in for December. So it looks like the market is not expecting a change today, which tells you that if there were, we would have some market reaction to that. We're also going to be looking at the summary of economic projections. Obviously, the economy has changed since the last time the Fed put out their numbers in December. We have seen stronger job growth and stronger inflation. Do they change either one of those? According to economists surveyed by Bloomberg, certainly they will change the inflation numbers. That could justify the idea of one fewer cut, but we'll have to see how those play together. What else are we going to see? Well, no significant change to the Fed's statement is expected. They took out a lot last time, including about how the banks are safe and that sort of thing, and talked about the need to basically see progress being made. And they promised a discussion of the balance sheet at this meeting, but they didn't promise any decisions, and the betting is we won't get any. They'll confirm they talked about it, but any kind of taper announcement would come later on. So finally, where does that leave us at the end? Well, take a look at what's happened in the markets over the last couple of months with the Fed. The red dots are when the Fed has met and Jay Powell's talked, and then the final one is Humphrey Hawkins the other day. And as you can see, we get this instant reaction of the markets looking at Powell sounding dovish and starting to lower rates, and then all of a sudden something happens, like CPI, and it turns around and goes back up again. We're way above where we were at the beginning of the year and above where we were at the December meeting. So, Manus, the bet would have to be that we're likely to see little change in that, or that rates are going to go up a little bit from here, given the history. But again, 2 p.m. today, and then 2:30 for Jay Powell's news conference.
Okay, all eyes and ears down for that. Mike, thank you very much. Hunkering down in Washington. JPMorgan's Mike Feroli is comfortable with the first cut in June, telling us this. Just as we thought there was an overreaction to the soft November and December inflation readings, we similarly view the recent commentary as overreacting to stronger January and February readings. We're at a crossroads in this conversation, so let's bring in my guest this morning. It is Bob Dole and JPMorgan's Mike Feroli. Bob Dole, of course, of Crossmark. Gentlemen, good to see you. Mike, good morning to you.
Morning.
So the market seems to be stuck at 3. You say it's at toying costs if we go from 3 dots to 2 dots. But if you look at the data and if you look at the rhetoric, you would say that Waller's commentary is perhaps the more prescient piece that we need to focus on.
Well, I think that's kind of where the debate's coming out to, right? Which is Powell sounded pretty dovish the other week before Congress, and he's, it seemed like the focus there is that inflation's coming down. They hiked because inflation was high, so now that it's coming down, they can reverse course. Waller seems to be a little more in the camp of, if growth isn't bad, what's the reason to cut rates? And I think that's probably where, the important debate is shaking out right now within the committee. But, and I think that's probably more important than the dots, whether we go from, because there's only a few people that could change it from 2 to 3. So it might be, this parlor game of focusing on which dot is going to move seems a little bit overstretched relative, I think, to the debate going on within the Federal Reserve Board itself.
It's amazing how we've managed to get ourselves spinning around on the spot on whether it's 3 cuts or 2 cuts, but they will be data dependent. Bob, good morning to you. You would make the point that it's about the stickiness of inflation, and this is the issue that Waller raised, isn't it? Bob, you're concerned about underlying inflation, that disinflation narrative having paused and maybe run out of breath.
Yeah, look, the last 2 months we all know was a bit of a surprise to the upside, and we've got time between now and June to see what a couple more numbers look like. If they are stubborn to the upside, there's no reason the Fed will move in June, in my view. Having said that, there are a lot of people smarter than me arguing that inflation is going to resume its downward trek, and if it does, then probably they go in June. So watch that inflation number, yes.
Michael, I'm drawn to last week's action. I had a week away where I wasn't sort of latched onto my Bloomberg every single day. But you look at the ferocity in the rates market, 24 basis points, 25 basis points at the short end. So to a certain extent, these bond markets, and I'm interested to know whether you agree, have already priced a hawkish tilt.
That seems to be the case. I think there is certainly some uneasiness going into this afternoon about a hawkish surprise. So, if we did move to 2 dots at 2 p.m., of course, that would, I'm not sure how much of a surprise that would be. But, I think actually the 2:30 development in the press conference might be a little more important because, this is, let's face it, this is Powell's committee. And if he sounded like he did before Congress, I think that would offset some of the hawkish fears out there. But no guarantee that he is going to sound as dovish as he did before Congress, because we have gotten those, or at least one additional set of hot inflation, CPI and PPI prints since then.
What is the risk that he does? What is the risk, Mike, that if he does sound slightly more dovish, as he did just in 10 days ago, that he actually emboldens that mania that we have in markets? Credit spreads incredibly tight, equity markets lit up. We can talk about why credit spreads are tight another time, but that is the risk, isn't it? It's getting that balance right between the ferocity of loose financial conditions, and that's what he wants to try and avoid emboldening, doesn't he? Mike, first of all.
Well, yeah, so certainly that is one of the arguments out there that the hawks are really pushing, is that it's a concern, that as you say, financial conditions are loose and getting looser. I think the counter to that would be, well, if productivity really is picking up, there is some justification for higher asset prices. And then coming back to what I mentioned earlier, I think from Powell's perspective, the point of these rate hikes hasn't been to crush the economy. The point has been to bring inflation down. So it comes back to, Bob's point, which is inflation going to be sticky here or not? And if you think we can continue the disinflation, there's no need to tighten financial conditions just for its own sake if you really are confident that we're getting back down to, somewhere in the low 2s, at least sub 2.5 on core PCE.
Okay, well, let's just take a piece of what Bob has put forward this morning. And Bob, you talk about the probability of a noticeable correction in markets. You talk about stubborn inflation numbers of late, increasing number of weakening statistics. The signs of reduced liquidity are starting soon, elevated bullish sentiment, and full, if not expensive valuations. We are becoming more concerned about the equity market. to what extent would a shift in the dot plot from 3 to 2 unseat the rally that you have in equities? Or what is it that makes you feel that these equity markets are a little bit stretched or beginning to feel stretched?
Well, you gave the list that I would argue, I would emphasize, at least in the short run, that bullish sentiment. Bull-bear ratio highest we've seen in 6 years, and that is a pretty good track record of short-term moves. Now, I don't want to stand in front of the freight train called momentum. Momentum goes until it doesn't anymore, and predicting the end of that is a fool's game. So I don't want to be overly cautious and take money off the table until the market tells us to. But I think there are accumulating signs to say that we might get a noticeable pullback.
Mike, can we talk about a global perspective? We're going to face probably, if things run to course, one of the biggest and most synchronized global cutting cycles since 2008. Now, a lot can happen to change that. I understand that. But from a market perspective, what does that evolution do for us? The Fed, we started the year with 6 cuts. We're now down to 3, people mooting maybe even 0. But the most synchronized cutting cycle in 16 years, from a global perspective, the impact?
Well, I mean, it follows one of the most synchronized hiking cycles that we've seen, in recent memory. And I think that speaks to the fact that there was a global common shock to inflation. So while we, in the U.S. often focus on U.S.-specific drivers of inflation, it really was not only just a developed market phenomena, but a global phenomena. So, but in our perspective, I think the Fed and other central banks for that matter, but particularly the Fed, are going to be operating with a pretty insular viewpoint in terms of focusing really on the domestic data and not being too swept away by what's happening in Frankfurt or in London, for that matter.
Indeed, I think maybe the Bank of Japan are more focused on what's happening in Washington rather than the vice versa. Bob Dole, Mike Feroli, you're sticking with me. Quick note on some of the markets that are moving ahead of the opening bell. I just wanted to check this. We've got some big moves in luxury. Kering, of course, is down 15%. Gucci sales falling 20% in Asia. This is a shock announcement from them. That is rippling through on the rest of the markets, not to the same extent LVMH and Hermes. But you're looking at over $7.5 billion worth of market cap being wiped off Kering. So this is a warning signal about luxury, a warning signal about Chinese high-end consumers. Let's see what's happening ahead of the opening bell. Abigail Doolittle is with me on set for our U.S. session. Abby.
Well, Manus, we do have U.S. futures ever so slightly lower, but despite this, we have a couple of stocks that are popping, one being Intel. They have received $20 billion in U.S. grants and loans for chip plants, the largest award from a program designed to reinvigorate the domestic chip industry. Tesla, now it's interesting you should bring up that China weakness, up 0.5% at this point. The rumor has become a reality. They are going to start raising their Model Y prices by $1,000 starting April 1st. Testing the appetite there for more expensive items, especially given the fact that there's so much EV competition. Boeing to the downside, though, down 1.7%. The CFO sees cash flows of up to $4.5 billion in the first quarter as that 737 MAX door plug event takes a toll via both factory slowdown and also greater regulatory scrutiny. Manus.
Abby, thank you very much. Some of the stocks moving ahead of the opening bell. Coming up, Apple's Tim Cook touches down in Shanghai. This as the U.S. weighs new sanctions on China. We're going to talk all things chips. That's next on Bloomberg.
The new kind of change in policy is that technology is a national security asset. So we should look at some of the government funding for technology similar to a defense budget. We are trying to rebuild our industrial base in the United States. That was what was behind the Inflation Reduction Act. That was behind the Chips and Science Act. That was behind the bipartisan infrastructure bill. And so the dollar amount that governments are willing to put into different sectors and into different companies is all national security driven.
Well, there is one stock that we are watching this morning. It is Intel. The share's fluctuating pre-market after winning $20 billion in grants from the US. This is going to help fund an expansion of semiconductor factories. It's the first company to land the money from the all-hailed 2022 CHIPS and Science Act. Mandeep Singh is with me. Mandeep, how much of a game changer is this for Intel, really, in terms of the size and scope for deployment of capital into the United States of America?
Yeah, I think it's coming in at a good time, given Intel is under so much pressure because, one, they are losing share to the likes of NVIDIA on the data center side. And look at their gross margin compression. I mean, it makes it very hard for them to continue to have, $20, $25 billion in CapEx every year. So at least it covers, part of the CapEx investment they have to make to catch up to a TSMC when it comes to advanced node manufacturing.
And of course, side by side with that, it's not lost on anybody that here we are, we have the administration. One could look at these grants and incentives for Intel as being a political banner to wave during this year of campaigning. But on the other side, we're talking about potentially more sanctions on Huawei's supply chain, the chip suppliers to Huawei. Now, this is potentially an escalation by the Biden administration. What do we know?
Well, so we know that Huawei, even though it was restricted, was able to make a new smartphone with a 5-nanometer chip, and they were able to procure the components, for everything they needed to pack in that smartphone. So it's more the restricted entities are being expanded to companies that were doing business with Huawei. And look, at the end of the day, right now, the focus is not only on advanced node manufacturing, but on device generative AI. Every company is trying to develop a chip that can be in your smartphone or your PC that can run AI, and I think that's where the restrictions come into play in terms of not letting Huawei develop that right now.
So we've had this sort of grand moment from NVIDIA. There's 2 days of rhetoric and showmanship from Huawei. So we have a time to digest what the next evolution is. We're at record highs. We're scaling up on NVIDIA. It's dragging everything else with it. After 2 days of reflection, what is your take on the NVIDIA 2-day San Jose expose?
I mean, look, the chips are in high demand. There are still supply constraints, and TSMC is the only game in town when it comes to manufacturing these chips. So all the data centers will likely use a lot of these NVIDIA accelerators, but the supply constraints is what's driving the ASPs for NVIDIA. And even NVIDIA would want, some of that manufacturing to be done, for example, in the US. And even if it's Intel, which is a competitor, I think they would be open to that idea. But obviously, time will tell in terms of how quickly the manufacturing capacity ramps up in the U.S.
Okay, it's all about delivery and accelerating that on the ground here, onshoring. Mandeep Singh with the very latest on the tech side. Bob Dole and Mike Feroli are my guests this morning. Bob, I want to get straight to you because I've had lots of people who've missed the boat on NVIDIA. They want the poor man's NVIDIA alternative. They want some Broadcom. There is a sense of mania with this NVIDIA story, but are you a buyer of the belief that it is the foothills of the next evolution, a new chip, a new form of technology that's been delivered? How engaged are you in this form of sort of mania?
Absolutely agree. It is revolutionary. I don't want to overdo it. Perhaps the market has, but I think you have to be there. This is a leap in our ability to produce value-added equipment, materials, adds to the productivity story that's so critical to our future. So I think you have to be involved in this space.
Mike, for a fixed income, for a sort of an economist who looks at the world and the Federal Reserve Day, I just wonder, I take my mind back to when Alan Greenspan he wrote a number of papers and he talked about a paradigm shift. I need to double check my facts. I think it was around the year 2000. I cannot be exact. But he talked about a paradigm shift in the birth of the internet. We didn't really understand. We had no grasp of what that was going to mean for global economies. To what extent does AI come into the conversations that you have around the table, and will it spill over into the Fed, or is it just too soon to go there?
Yeah, so it's certainly coming into conversations. I think in part, last year we did see better productivity performance for the first time in a while. So that got people asking, could this be, the first hint of AI? And, you talk about Greenspan. Greenspan really kind of sniffed out the productivity improvement by a lot of, data forensics before it was obvious in the mid-90s. And so I think a lot of people right now are saying, are we, at the edge of another period like the late 90s, which was really a phenomenal period of productivity growth. And certainly I have seen, the projections which suggest you could get pretty substantial productivity gains from this. On the other hand, you go back 10, 15 years and there were similarly techno-optimists telling stories which didn't bear fruition. So, but right now I think it is, it's certainly for a longer run discussion, not for the next month or two or the June hike or anything like that. I think when it comes to, Fed policy, this may affect how one thinks about longer term interest rates and that longer run dot.
Just on that, Mike, do you think that is where we're getting hung up on 3 cuts, 2 cuts, in terms dots, excuse me.
Yeah.
Maybe the more important conversation, apart from balance sheet, is where that longer term neutral rate is, and that I presume you would go down with the stake going, Manus, that is considerably higher.
Yeah, so I do think it's important. It's crucially important for all assets where longer-term interest rates settle. Those dots are just their estimates, of course. There are a lot of good economists there. But, certainly I think there is a risk that moves higher, and in part because of some building optimism on productivity. Less favorably, there's also some sense that these chronic deficits are leading to more crowding out, which raises interest rates. So,
okay.
Yeah.
Mike, thank you so much.
Sure.
Bob Dole, Mike Feroli on Fed Day. Coming up, your morning calls, and a little bit later, John Hancock's. Emily Roland joins me to discuss the road ahead for the Fed and what it could mean for equity markets. That conversation coming up on Bloomberg. Get you up to speed with your morning calls from Wall Street. First up, Needham upgrades CarMax to buy, expecting the shares to benefit from the used car market continuing to rebound. Next up is Tesla Advisory upgrading Best Buy to outperform, highlighting the new product innovations and strengthening traffic trends. And finally, Citigroup downgrades Wells Fargo to neutral, seeing limited upside for the stock's recent outperformance. Good to see I know what day of the week it is. We're all safe. John Hancock's Emily Roland unveils her strategy for gaming the Federal Reserve. That conversation next on Bloomberg. Moments away from the cash opening, we're still managing to put in records into these markets. It is Fed Day. Are you prepared for a hawkish tilt? What will Jay Powell have to say a little bit later on today? We'll bring that to you full and square. Intel is just pumping up higher. They've got $20 billion of incentives from the government. There's the opening bell ringing now. $20 billion in incentives coming through. Intel gives back 1.5%. Let's just check whether that is the pre-market on that, rolling it over. That's the state of play there. Let me just show you what's going on in the bond market on this Fed Day. We have got the dollar on a run and yields just ticking down. There is the cash opening of Intel now, as you can see, up 1.9%. On the bond market, to a certain extent, you had a ferocious week running up into this Fed decision day, up 25 basis points last week. Yields tipped down. 428 is where we are. The dollar index is on a tear, the best run in 10 weeks, up for the 5th week in a row. I mean, it's literally, the Fed was supposed to take a wrecking ball to rates. That has not happened, and so that has underpinned this dollar. Bitcoin down by 0.6%. You're seeing, some would say, an evaporating demand for the ETFs. So we're down for 3 days in a row now on Bitcoin. Okay, I mentioned it to you, Intel, it's on the open now in the cash market. The chip maker winning $20 billion of awards designed to reinvigorate the industry. That is the all-important question on timing. Abby, what have we got?
Well, we do have investors liking this because surprisingly, Intel on the year not participating in the big tech rally. It's actually down about 15%, but today up 1.7%, the best day in more than a week. So a bit of a bid here. And of course, it does come on this news that they're receiving the largest award so far out of that 2019, I believe it was 2019 CHIPS Act that's meant to reinvigorate the chip activity here in the U.S. Overall set aside $39 billion. So they're getting a really good chunk of it with $8.5 billion in grants and as much as $11 billion in loans. This will help to fund expansion of some of their semiconductor factories in both Arizona and Ohio. And it's not just the stock trading higher, Manus. We also have Intel bond trading jumping. So it seems as though both stock and bond investors like the fact that Intel is getting this money to help, again, as you were mentioning, reinvigorate the chip industry here in the U.S.
Indeed. Abby, thank you very much. Let's stick with those chip makers. NVIDIA's AI Woodstock event continues. The CEO looks to buy Samsung's memory chips. Ed Ludlow is with me from San Francisco. Ed, it's been a busy old week. Fill us in on the latest.
Yeah, and it keeps going. I mean, in the first instance in the markets, NVIDIA is seeing its stock or price targets raised on its stock by a few different names. Piper Sandler raising the price target to $1,050 from $850. Another raise elsewhere. I think Citi also raised its call on that stock. We spent 90 minutes with Jensen Huang yesterday talking about what happens next. And it's basically this. Blackwell, the latest AI accelerator or GPU, starts shipping late 2024, that we don't have any sort of more specific or concrete date. Jensen is framing this as a $250 billion annual market as it stands that he sees growing 20 to 25% annually from here on in. That is high-performance GPUs or server designs, rack server designs that go into data centers specifically for training large language models and processing them in the process known as inference. The other big story that you will have seen kind of from a market-moving perspective is that Samsung had a pretty sizable move overnight in Korea. And I want to clarify something because Nikkei was reporting that that NVIDIA might use Samsung's latest generation memory chips, HBM3E, high bandwidth memory 3E. Jensen Huang was asked about this during that Q&A. And what he said was that NVIDIA is qualifying Samsung's HBM3 technology. They're also looking at SK Hynix. And he values both of those partnerships. But in simple layman's terms, if you build a data center and into that data center you have a combination of GPU and CPU, you also have to have the memory to support the transfer of data across the design of that server. So inevitably there'll be some spend there from NVIDIA's perspective, and they're looking at both those names. So the stock's up 0.9%, a lot of fanfare, a lot of interest. Keep your eyes peeled to social media because I'll have a little look behind the scenes of what it was like at GTC when I was there yesterday.
Look forward to it, Ed. Thank you very much, Ed Ludlow there. Let's turn our attention to the earnings narrative. General Mills reporting sales and volumes that topped expectations, how cushioning the blow from softening demand. Isabel Lee is with me for more. Isabel.
Hey, Manus, shares are rising around 4%. Analysts also noted a significant improvement in its pet segment. So there's a lot of factors to cheer, and the company stock closed above the 200-day moving average for the first time since 2023 June yesterday. So as we know, that's a sign of a general uptrend for the stock. And General Mills, which is the maker of Cheerios and Yoplait, reported adjusted EPS of $1.17. That's higher than the $1.05 estimates, and adjusted gross margin also came in line with estimates, up around 34%. So despite the beat, annual forecasts were maintained. The company said that a huge part of their performance for the fiscal year this year is really going to be based on three things: the economic health of consumers, the moderating rate of input cost inflation, and of course the stability of the supply chain. But for now, shares are rising around 3%, paired some of those gains. But in other news, we have Chipotle rising around 7%. That's a high for the stock. So why is shares rising? Because really the company approved a 50-to-1 stock split. So They will seek shareholder approval in their meeting in June. So what does this mean, Manus? As we know, stock splits are really just a cosmetic move. It doesn't really do anything. It just doesn't change the fundamentals of the company or the valuation, in fact. But it's a psychological effect, and it's really meant to attract retail investors. And we have a Baird analyst saying that this is a good move, also in a sense that it will improve trading liquidity. And the company also said that they have a one-time equity grant for the restaurant general managers and long-tenured crew members, and the analyst also said that that's a good sign. Shares are now popping up 7%, Manus.
Isabel, thank you very much. Pivot to airlines. JetBlue eliminating some of the unprofitable routes for them. It's a sweeping overhaul of the network. This is the carrier looks to cut costs. Alex Semenova is with me now. Alex, this is about a sort of truth and reconciliation moment, isn't it, for JetBlue?
Indeed, Manus. If you're planning on flying out of JFK in New York to Detroit or from Orlando to Salt Lake City, don't count on flying JetBlue. The company said that it's eliminating a number of unprofitable routes, both in the U.S. and internationally. In an effort to cut costs, the airline will fully exit Kansas City, Missouri, as well as Newburgh, New York, as part of this effort. It's also reducing the number of flights to LAX to 24 from 34 per day. The company said in a statement that this will free up aircrafts to fly profitable routes and also reduce potential delays for customers. Shares were down as much as 2% here into the open. And sticking with air travel here, Manus, I want to turn to Boeing as well. The company predicted a massive cash drain for the first quarter after regulatory scrutiny and slower production of its 737 MAX jets dented its finances. This is, of course, after a number of technical issues with that 737 jet. Cash outflow will reach up to $4.5 billion in the first quarter. This is according to comments from Boeing CFO Brian West at a Bank of America conference in London earlier today. For the year, free cash flow will be in the single-digit billions of dollars. West also said that margins at the commercial aircraft business will be negative to the tune of about 20% in the first quarter. And separately, Boeing is looking at how Spirit Aerosystems could sharply reduce its ties to Airbus ahead of a potential acquisition. Shares are up slightly this morning.
Okay, Alex, thank you so much. Emily Roland of John Hancock Investment Management weighs in on the markets today. From a macro to markets, it seems like everything is awesome. We would not get caught up in the hype. Instead, we would trim into strength and redeploy capital into places with less valuation risk. Emily, good morning. A voice of caution and reason in the euphoria. Good to see you. I mean, there is a sense of awesomeness in this, and everybody's telling me the earnings will carry through, and I'm not to get preoccupied about 3 cuts or 2 cuts. But what is it that causes you a sense of wariness? And where are you seeing pockets of extreme euphoria?
Yeah, markets, Manus, really haven't cared much at all about the macroeconomic backdrop as of late. And I think that's what's made investing really difficult. And you've had a number of guests this morning that have talked about the momentum factor and sentiment really driving markets higher. And that's been the name of the game so far this year. That's a really tough force to fight, but we really want to focus on what's happening here. And I do think that the Fed meeting is going to be really critical today. We may see Chair Powell coming out and kind of acting as the adult in the room. You know, it kind of feels like markets have been on spring break and it's time for a parent to come in and break up the party a little bit. And his job is really difficult right now. You know, we've had progress on inflation stalling over the past 8 months. Last week, we had PPI and CPI beat on the upside. And another dynamic that's playing out, making Chair Powell's job more difficult, is that China is stimulating in the form of monetary policy and fiscal policy moves here. And that's creating a growth impulse throughout markets.
Do you really think the China stimulus? Do you really think the China stimulus? I mean, there's a lot to unpack there. I mean, first of all, I don't think the markets got the message from Miami, which was don't come to Miami on spring break.
Yeah.
It's a great analogy. It's a fantastic analogy. But I do just want to push back a little bit. Look, we've seen the China stimulus narrative announced, but to what extent has that actually been deployed and therefore carried through to a potential inflation risk for here in the United States? Let's square that away first of all.
Yeah, it's a great point. Sometimes it is just the announcement or the news that really spurs this market reaction. And that's really what we're watching. And one place we're seeing it is in things like copper prices. We've seen copper prices surging. Typically, when you see industrial metals rising to this extent, that's a sign that growth globally is reaccelerated and then inflation's perking back up. So we were getting deflation out of China for quite some time, and now that narrative has shifted. And we think that that's a pretty important component that's causing this reacceleration in inflation. Now, it's not that significant. You know, the Fed in the last summary of economic projections said they estimated core PCE to come down to about 2.5%. We're not that far away from that. But I think some of these recent developments are going to cause the Fed to potentially, signal that, don't get too excited about 3 cuts coming this year, maybe fewer than that.
Yeah, and there is a real risk. It's a tail risk, but there's a tail risk of no cuts. So take me back to the spring breakers, because you've now instilled in my mind this vision of how I used to be when I was very, very, very young. So spring breakers are riotous by nature. They're ebullient. They're excited. So where's the biggest risk? Which group are the biggest risk of crashing and burning late at night?
Yes, I was inspired by this analogy, of course, from personal experience as well, Manus. But, of course, you look at the hype around AI, around tech. We look at things like the S&P 500 growth index, which is where all the tech titans reside. And it's trading at about a 45% premium to its 20-year average. Now, we've got to be really careful here, because there's not anything fundamentally wrong with some of these big tech names. The earnings are great. You look at S&P 500 tech sector earnings in the fourth quarter, 90% beat rate versus 75% for the broad index. The magnitude of those beats, significant at a full 10 percentage points. So the earnings are there. The challenge, of course, is it's pretty tough to argue that those names are not overbought.
Now, you would also say that there are certain sectors that had a brutal 2023, healthcare being one of those. You talk about valuation opportunity, but also you would present that as being, when people talk about go for breadth, that is one of the squares that you would put forward on the board as being a breadth option.
Exactly. We're not downgrading technology because of some of the things that I just talked about, but you've got to look for places that have less valuation risk. Healthcare, as you mentioned, one area that was left in the dust last year that's now trading at a 10% discount. We think healthcare should do fine in a slowly decelerating global economic growth backdrop. We look at U.S. mid-cap equities, which are trading at the steepest discount to their large cap counterparts since the late 1990s. They're also benefiting from onshoring trends with a significant overweight to the industrial sector. And then we just think other parts of the value complex deserve a look, like energy stocks. Our portfolio managers are leaning in there as we've seen continued limited supply. And now, again, with the China story, demand is starting to pick up a little bit. So I think you can pick up some spots that are trading at a pretty significant discount to help balance out that mega cap tech exposure.
And this is where, if I put a bow on the package, this is where you would then say that energy and industrials will be a tailwind. They will receive a tailwind with that broader economic position, which remains intact here in the United States of America, and that tailwind from China.
That's exactly right. So, more cyclical sectors, I think you've got to be thoughtful about which ones you look at, and an active approach makes a lot of sense here. But we can't ignore the fact that global economic growth is seeing an improvement. We look at things like PMIs across the globe. They're perking up, especially in areas like Europe, and we want to be mindful of that. We don't want to reach too far over our skis and taking risks, but we certainly want to participate as we're seeing this chop in economic data start to, look like it may be a trend in which there could be more participation from more cyclical areas of the market.
Emily, a voice of reason in this moment of euphoria in markets. I'm seeing $1,000 calls on Nvidia from Piper Sandler. So we'll hold fire. Let's see what Powell's got to say later today. Coming up, Reddit gearing up for its IPO.
Investor appetite is as strong as it's been in a very long time for IPOs. Part of that is because there really is a dearth of growth technology assets in the public market that are at scale today.
The IPO is expected to price today, starting to trade on Thursday. That conversation next on Bloomberg.
Investor appetite is as strong as it's been in a very long time for IPOs. Part of that is because there really is a dearth of growth technology assets in the public market that are at scale today. And if you look at all of the public tech companies, over $2 billion market cap, less than 30 have growth rates over 30%. So investors are looking for opportunities for growth in the IPO market.
This is going to be one of the most highly anticipated IPOs of 2024. Reddit is expected to price after the closing bell. The company and its shareholders look to raise as much as $748 million. That's according to the company filing. Wall Street expects the shares to start trading on the NYSE tomorrow under the ticker ORDDT. Ed Ludlow is with me. This better not be a Robin Hood take two. That's all I'm saying to you. Ed, what have we got? We've got a pretty good bid on this coverage on this stock at the moment. Take it away.
Yeah, I think a lot of people are looking forward to a Reddit listing. It's been a long time coming, right? This is one of the kind of OG Silicon Valley tech companies. It was one of the original Y Combinator incubated startups, founded 2005. So it's an almost 20-year path to the public markets. You know, acquired by Condé Nast 2006, spun out of Condé Nast 2011. And that chart that you're showing right now is interesting. The question raised by that soundbite is like the growth trajectory. It's a company that posted $666 million of revenue 2022. That rose to more than $800 million 2023, but it's still not profitable. And in terms of the mechanics of this listing, shares priced $31 to $34 at the top end of the range, as you said, seeking to raise as much as $748 million. A lot of those shares will go to employees and insiders. 8% of the offering will go to Redditors themselves, those that use the platform. And on a diluted basis, the valuation $6.4 billion. So, you know, let's stay tuned. Let's see how the market looks at this one. An advertising-based business that's also touting its AI story, where it sells its data in a licensing program. That seems to be the future.
We're actually just getting one small headline that Reddit holders said to guide the IPO pricing at the top of the range. And if we look at that range, that is, what, $31 to $34. So the top of the range would be $34. Talk to me a little bit more about the data, because this is, I think, probably the most interesting sort of tiny little fact of the day, which was lovely, which was Sam Altman at some juncture for a couple of days ran this company. But talk to me about the data, because that's where the value really lies in this. And this is about licensing the data to artificial intelligence companies.
Yeah, and I don't know if the director's listening, but we can bring back that chart that shows the user base, right? So there's around 71 million users on the platform. It is a forum or community-based platform where groups are organized by subject matter. There is high volumes, just tons of data, which is in text form. And the position of posts is positioned by the community voting on their placement. So more popular votes posts are voted to the top of the list. The idea is that it's just a big body of text that Reddit can sell to an AI company to train large language models on. But we don't know much more than that. You know, as an advertising-based platform, Reddit competes with all the other social media platforms, but it doesn't have any visual component, really. It's a text-based platform. So the licensing of its data for use in AI is interesting, though I think we need to learn quite a lot more about the market there, like how much money they're going to make. We know that OpenAI, for example, is in battles with the publishers in that data context.
I'm fascinated to know what your following on Reddit actually is, and I'll hop on there and have a little look and see what the comments are about you. Great work over the past couple of days, you and the technology team there following the NVIDIA story. So hop onto Reddit and you can see what Ed's following is. We're going to get some sector price action. Abby is with me. I wonder, will there be any surprise? Abby?
Not much surprise here at all, given the fact that we are waiting on the Fed and that policy decision and color out of the press conference. Very small moves. The S&P 500 itself is down slightly. The top sector, utilities, defensive, up just 0.3%. The worst sector, healthcare, down 0.4%. Those tech indexes not getting any sort of bid out of the upcoming Reddit IPO. But again, we are waiting on the Fed. So let's take a look at what's happening on the year, and 10 of the 11 S&P 500 sectors are higher. You can see communication services up 14%, tech up about 12%. The one down sector, real estate, utilities, up just 1%. That has everything to do with yields higher. The Fed is going to have an interesting play on this composition.
Okay, Abby, thank you so much. Abigail Doolittle coming up. Market moving events for your day. There is really only one. It is the Fed. But we'll run you through the diary in just a moment. Good morning from New York.